From the 6th floor of 3 Financial Center in West Little Rock, Arkansas, welcome in. And whether you're listening on the GenWealth Radio Hour or watching on our live stream or after it is recorded on Facebook or YouTube, settle in. We've got about 45 minutes of a new format from GenWealth Financial Advisors. My name is Scott Inman. Along with me is Teresa Arago from the Conway office. And I don't know what it says about you that you get put into the chair the day we change everything.
Hopefully it means that you guys trust me and that I'm reliable. That's what I'm going to choose to believe.
I like it. I think that's good. We've also got a special guest when we get into the Get Ready for the Future show a little bit later on as well. We'll bring in. But when we talk about changing, I shouldn't have said that we're changing everything. We're not really changing everything. The Get Ready for the Future show is still going to be the Get Ready for the Future show. We're going to answer your questions on that, and that is coming up in a little bit. But as you saw there at the top, we've got a new segment here on the radio hour and online called What's Happening. We look at current events regarding finance, regarding your money, retirement, legislative changes to retirement all the time, and that is brought out weekly in our 4-minute segment, the fastest 4 minutes in finance, which is also part of the radio hour, also a standalone that you can get delivered to your email inbox. We'll tell you a little bit about that, how to get that in just a minute. But that's a very brief, centric on one topic. And we wanted to kind of bring in a little bit more discussion about what's happening in the world, and especially as it relates to your money.
Yes, and I think it's really great that we're starting this because, like you mentioned, in the fastest 4, you cover one topic and you hit it fast and hard, and you get some details. But here we're able to go even deeper into some topics that are upcoming or that have just happened that you need to know about so that you can make wise choices about your financial journey. Yeah,
so for our radio listeners, the new format's going to be 15 minutes or so of the what's happening, looking at current events, and then about 30 minutes or so of answering your questions in the Get Ready for the Future show. So as we settle in, we were digging through the things that we were going to talk about today, and we had this article that we had found about gold and silver trading near record highs, and the article says that Wall Street thinks there's more to come. Well, how timely is this that just yesterday, and yesterday being Tuesday, October 21st, because we're recording here on Wednesday, October 22nd, that gold dropped 6.3% and down another 1.3%-ish as we are on the air right now. That 6.3% drop was the largest intraday drop since 2013. So, and that article that we were focusing on from Yahoo Finance was written last week. So when you think about that, and we did a fastest 4 piece, by the way, on gold, and I want to encourage you to sign up for that. You can also go to our YouTube channel. You can search fastest 4 minutes in finance. You can find that piece, but we did a piece on gold because it's all the rage right now. Anytime there's uncertainty in the economy moving forward, worries about markets, especially as they get to all-time highs. Teresa, people really do flock to gold. It is an actual thing, and many times it's institutional, maybe times it's government, but people get interested in gold when they're uncertain about other things. But today and yesterday have proven to us that gold can be just as volatile as the stock market.
And I think that's the thing. I want to reiterate that was in a single day. You know, a lot of times you expect the larger market to do things like that, but people have this misperception that gold is just stable. It will always be stable. It always has been, and it hasn't. And that's the thing to understand. All investments have risk, gold included. So when you're making a decision, we would encourage you not to make it out of fear in general, but certainly to make it out of looking at the whole picture. But I'm with you. When we read this to prepare for this week and it said there's more to come, I went, okay, how much further can you push it? Yeah. Really? Is it that gold is that much more valuable, or is it that a lot of people are buying it so the price just went up?
Right. And that's what's happening. So gold, looking at it now, just hovering right above $4,000, $4,053.80 per ounce. That article from Yahoo Finance made some speculations it could reach $6,000 by the end of the year. And again, we don't know what's going to happen by the end of the year. We're only talking about a short time frame that it dropped. But there was some analysis inside of that article that talked about, I believe it was a J.P. Morgan analyst that said it had been on a 6-week tear of going up, and usually when that happens, it does come back down. So it did. And now, but again, I think for me, the larger piece, and we brought this out in the fastest 4 with regard to gold, I'm not a big fan of it. I'm just going to be honest with you. We don't put it in clients' portfolios when we're planning for retirement. I'm not saying you can't own it. That's fine. But the idea that it is a safe haven, that it is the place you go to be safe, to have a conservative investment, that's the misunderstanding, I think, that needs to be brought out in our discussion about this.
I have an issue typically with any investment that is really driven by fear.
Yeah.
You want to make sure that your investments are logical and fit within the overarching plan that you have. So anytime something is a fear-mongered purchase, I'm always worried about it when it comes to my clients. So I'm with you. I've never been a big fan of it, only because of how it's postured.
Yeah, and how do you really analyze the true value of it? Because it is currency. It is a precious metal, but it's also considered currency, and that has no underlying fundamental intrinsic value. You can analyze a stock, you can analyze a fund that holds multiple stocks, and you can say, hey, these companies are worth this because of X, Y, and Z.
Yes.
You can't really do that with gold.
And they can be overinflated too.
Yeah,
there are
that's
lots
right.
of, we had GameStop a few years ago,
Yeah.
right? There's several right now.
Sure.
But when you look at gold and silver, the conversation I usually get from clients is, well, if the economy fails, gold and silver are going to save the day. And I'm like, okay, can you eat it? Can you use it to build things, for your home realistically? So if you're in that kind of stage of being concerned, this, I think, has just shown that volatility can exist, and to be mindful that your purchases make sense when you're investing.
Great way to wrap that up on gold. Okay, so another headline we saw, sticker shock. Car prices top $50,000 for the first time in the U.S., according to Kelley Blue Book. How about that? $50,000. The average transaction price for a new vehicle in the U.S. has crossed the $50,000 mark for the first time. That's not too far away from what I paid for my first house in 1999. I mean, this is crazy.
Yeah.
And my take on this is I really think that it's because of all the extra stuff we're putting in and on vehicles, right? I mean, the technology in a vehicle today is off the charts compared to when you and I were buying our first vehicle. So that is going to drive the prices up, and inflation just naturally is going to make things higher. But to say that our average price now is $50,000 for a vehicle, I think that's very concerning to middle America, middle income earners. I think for younger people who are buying their first cars out on their own. Now, that's not to say you can't find one for less than $50,000. And I thought there was an interesting piece to this. The reason for that shift is because more expensive models, the luxuries and the luxury vehicles and the EVs, the electric vehicles, are a larger share of the sales. They're going more off the lots than other vehicles, so that skews the average upward. So higher earners are kind of driving that number up.
I would argue with you a little bit on that. I think some of our middle income earners are just overextending themselves to get these luxury cars. I've seen a lot of young people buying very expensive vehicles, just assuming that's just part of life now, is that we're just going to pay these huge sums for a vehicle. I had a similar experience, ended up spending a lot more on a car than I wanted to because my son's car died. My husband and I needed to get a replacement. We were just going to buy him a clunker again. He's young. He doesn't need anything fancy.
Right.
Couldn't find one. So we were forced to consider a new car for us, and kind of doing the thing where you pass cars down because we couldn't find anything that was reasonable to give to an 18-year-old. So I think there's the combination of, you're right, there's so much in our cars making them more expensive in general with inflation and the added technology. But also I think a lot of people are just seeing this as part of life and overextending themselves, which is the part that makes me concerned when it comes to their financial journey.
So some takeaways here for us as we address this on how you should deal with that. I mean, I think that obviously this is the vehicle deal. You have to have one, right? So how you make this purchase and go about it is very important to your financial future, because don't just accept that you got to pay $50,000 for a vehicle. That's not what you should do. So, I saw in the article here, some of the things they talked about is they're going for used cars, because again, that's a new car, right? $50,000 is the average cost for a new vehicle. You don't have to have a new car. There are great used cars that last a long time you can go for and get a lot cheaper. some people are opting for longer loans. Don't do that. I mean, that's up to like 72, 84-month loans now. I mean, you're never going to get.
The car won't last that long in some cases.
I mean, yeah, exactly. We're not proponents of auto loans in general. We want you to be able to pay cash for a vehicle. I do understand there are lots of circumstances where you can't start off that way. But if you're going to have a goal of eventually not having a car payment, you can't be paying for one for 72 or 84 months.
Exactly. And if you do have to do that to make it affordable at first, I encourage you to come up with a strategy to expedite paying it off.
Yeah.
So if you're in a pickle like we were, where you absolutely have no other option but to buy something, we were able to put a hefty down payment. We did have to get a loan, but we have been making extra payments to pay it off quicker. So there's things you can do to help get yourself out of that. But you are correct. Take the time to shop. Take the time to really know your terms and be cautious of overextending yourself.
Yeah, and I think about, there's no way that you can't get a new vehicle for a lot less than $50,000. I bought one for.
To be clear, we did not get a $50,000 car.
Right. Yeah. I mean, you can get them in the mid to upper 20s, brand new, which says to me you can still find a good low mileage used one for about $20,000.
Yes.
And that, when I think about it in that, because my first vehicle at 14, I got one when I was 14.
Okay.
So doing the math on that, late 80s somewhere.
That's Stuttgart for you, I guess.
Yeah. You know what I paid for it?
What?
$3,000.
Hey, I paid $1,000 for my first car
and it was
in
a pickup.
1997.
Mine was a pickup.
A pickup,
$3,000.
okay.
Now, we put about 3 more in it, fixing it up.
Mine was not new, so yeah, there was that.
But I think in the next piece that we're going to do to close out this segment is also going to be on just the higher cost of things. But the car price thing for me, I think that's astounding, but you've got to be able to find that for less. And if you have to have a loan, as Teresa said, figure out a way to create a plan to pay it off, accelerate the payoff of the loan. And then another piece, and Tim's fond of saying this, and I'm a big proponent of this as well, continue to pay that to yourself when it is.
Put it in savings.
Put it in savings.
So the next time you're buying a car, you've got your trade-in plus your savings, and you don't have to take a loan. That's a great strategy.
You got to get ahead of that at some point in your life, or you're going to be chasing a depreciating asset all the way through your work life, and that's never going to get you anywhere. Okay, final topic on our What's Happening segment today, from this article that says median home buyer is now up. The median home buyer in 1985 in the United States was 33 years old, and today it is 56. That is astounding as well. I do worry about this for younger people. Home, new home, and really any home, affordability is certainly a big concern in this country right now. We saw the explosion of prices of homes in 2021.
Yes.
When the inflation really took off, the home prices were very inflated, and they haven't really come back down much. I have talked to a few realtors that said they are starting to come back down. They're never going to come back down that far, I don't think. But the median age of U.S. home buyers has jumped from 33 to 56, according to the National Association of Realtors, one of the sharpest generational shifts ever recorded in the U.S. housing market. So when you look at what's driving it, so we just talked about the soaring home prices, high interest rates. I would say higher interest rates. They're not really historically high, but I think there's recency bias there when people have had loans or seen loans sub 4, maybe even sub 3%. 6% does look pretty high.
Well, and I'm one of those people because I bought my house that I'm currently in at like 2%. And my family would love to get another home, but I just can't justify it right now because when you add in, the actual loan being higher and then the interest being triple, that adds up so fast. And so for us, it has been a deterrent to buying another home for us. But this is talking about first-time home buyers.
Yeah.
So is that potentially related to student loan debt and, pay raises not being in place to help people really build enough assets? There's a lot that can play into this, but definitely it does concern me too, because home ownership is it's about building that long-term wealth too. I think it's a big step for a lot of people, and it brings a lot of pride to own a home. So for people not to have that opportunity sooner, that kind of makes me sad.
Yeah. There was a piece in here that talks about student debt and limited savings. But the silver lining in that, though, is it says millennials and Gen Z are delaying home purchases while prioritizing debt repayment and building emergency funds. So I would say that's the right prioritization.
Yes.
Getting the cash down for that sizable down payment so you can make sure you get a mortgage payment that you can afford, because that's the reflection of the interest rate. The combination of higher home prices and a higher interest rate means they're affording less home, right?
Yes.
And they've got to be prepared for it. So it's not necessarily that getting into a home a little later in life is a bad thing, but I think that younger people are being priced out of the home buying market in a lot of ways, in certain areas for sure.
And there's been a lot of just cash offers coming out that younger investors and home buyers can't compete with.
That's right.
If you've got someone walking up saying, "I'll pay you $300,000 cash," when your asking price was $298, you're not even going to look at these other people's offers. And so that has also been a challenge since 2020 when all that started. But, this trend could reshape the long-term retirement and investment patterns when people start renting instead of owning homes as a larger part of the population. So there are some shifts that we may see. But I'm with you. I'm kind of hopeful that maybe our younger kids are prioritizing their finances a little better.
What'd you think about the first one? First one ever, the What's Happening segment.
I think it was good.
Yeah, I think it's good too. It's going to get
Hopefully,
better.
Well, I don't know. We'll see what everybody else thinks.
It was good. Hey, and if you want to submit some things that we talk about, I'm just thinking of this on the fly. Nobody's told me to do this. You can send us an email, right? You can send us an email to show@getreadyforthefuture.com, something you want to hear us talk about. But I love that. Ripping the headlines, talking about what's happening. Stay tuned. We're going to answer your questions about money now.
You've been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Helping people discover, protect, and share true financial independence. This is the Get Ready for the Future show from GenWealth Financial Advisors. Glad to have you along. Scott Inman, Teresa Arago. For the next 30 minutes or so, we're going to be answering your questions. And you can send us anything about finance, your money, retirement, anything you want to talk about, investing. And you can do that by texting or leaving a voicemail to 501-381-5228. It's 501-381-5228. Leave a voicemail or shoot us a text. We might use your question on next week's show. We've got them lined up for today's show, though. We've got 4 questions, and the first one is about estate planning. We go to Susie from Texarkana. She writes, "We're 67 and 65 and just paid off our house. We've heard that having a trust avoids probate, but our estate isn't that complicated. How do we know if a trust is worth the cost?" Wills are simple, and we can definitely clarify for you. Trusts do avoid probate, but which one is right for you? If you're not sure where your estate fits, don't miss this conversation if you're Susie or if you're anybody else wondering that. And for that, we have a special guest to answer that. We have an estate planning associate here with us at GenWealth now. Marae Tudor joined the team not that long ago, and she's we should have probably told you this when we hired you, Marae, that if you are going to be on the GenWealth team, you're going to eventually be on camera and be on the Get Ready for the Future show.
I don't know if we put that in her interview questions to prepare her, but she's handled it well. Oh,
yes.
It was implied.
Well, welcome, first of all, to the show. You've been on the team now for several months, but you are providing a great service for our clients to provide some estate planning so that they can kind of go shop in one place, right? They can get their retirement planning done, and they can also get their estate planning done right here at GenWealth. But when you look at Susie's question there about hearing that a trust avoids probate, and their estate's not that complicated, let's talk a little bit about, if you would, the differences between a will and a trust.
So, a will, it will not bypass probate, but a trust will. And only a will is a public process. So if you want to keep everything private, your best bet is to come in and get an estate plan. A trust can own some of your assets while you're still living, and trusts are more expensive to set up, but here we do it for $1,500.
Mm-hmm.
Okay. Yeah.
And I can tell you from personal experience, when my stepdad passed away and I had to probate that estate that they had, a little bitty piece of property up at Dardanelle, it was over $3,000.
Wow.
To do that probate process. And that was a friend of a friend, not what it would have cost me to use someone else. So
and that's a percentage of the estate
usually
value,
it
right?
is.
So it can be way higher than that.
Yes. They have their base rate, but it is usually anywhere from 3 to 7% of the estate value. So from a cost standpoint, even when you ignore all the chaos that comes with it, Murray, I would say it's really important to consider. And it's not just about having the trust, it's about funding it. So talk a little bit about that process.
So in order to fund your trust, a lot of times people will retitle their home and put their home into the trust. And so your trust isn't even really active until you actually fund it.
Yeah, and that's a good point too, because in many cases the investments won't be funding the trust right away. Things like IRAs and 401ks have to remain in individual names. So in that case, the trust would be a beneficiary, either primary or contingent. We usually favor contingent here. The spouse is usually the primary, and then the trust ends up being contingent. So that gets funded after your death. But that's a great point, especially since Susie's asking about the house. The house could be owned by the trust while they are still living, and there are a lot of advantages to that. I want to kind of dip back in, Murray. You talked about the $1,500 cost for the estate planning services here, and that would be a trust and a will. It's a pour-over will in most cases. But let's talk a little bit about the full estate plan, because I think people do get focused, and when we get questions about this, it's usually about a will or a trust or both. But there are other estate planning considerations that are included in the package that we offer for $1,500.
So we also offer an advanced healthcare directive and a financial power of attorney. And both of those are very important because it allows your loved ones to make decisions for you and on your behalf, and make sure that your wishes are honored whenever you aren't able to make those decisions for yourself.
And I think for me, my dad had gone through a long medical journey before he passed away. It would have been so good to know what he wanted instead of having to guess. Because that was beyond the just logistics of trying to do all that for him.
Yep.
Knowing that I had honored him would have been really nice to know that I did the things he wanted. I dealt with the things he wanted in the way he wanted, so he still had dignity even in those moments. But I also want to be very clear. I want to circle back to the house. One common things that I see a lot of clients want to do is they will go ahead and deed their house over to a child, and during their lifetime. That could create a tax bomb for your child if they sell it later.
That's right.
So I want to encourage you to consider using your estate plan, talk to an attorney, or come and talk to Murray to discuss how to do that in a more tax efficient way. Because when you pass away, if your house was worth $300,000 the day you passed away, and then your kid sells it for $320,000 a year later, they're only paying taxes on the difference, as opposed to if you add them to your house today and you, like Scott, that house, bought it for less than $50,000. Now when they sell it for $320,000, they're going to pay taxes on the difference. So it's really important that you consider the options available to you that can protect your assets, protect your financial independence without having to do all these gymnastics.
Yeah, it was close to 50, not really. It was 80. I was just saying.
Mine
it
was
too. It was in the ballpark.
Yeah.
But that's a great point. I mean, that house is probably worth 200 today, right?
Well, and I've seen where clients have family land where great grandpa bought it, deeded it over to daddy or grandpa, and then grandpa deeded it over to daddy, and now it's deeded over to them. Well, when they go to sell that, it's going back to the $5 per acre price that great granddaddy bought it for.
Yeah.
So estate planning and funding it properly can protect you from that.
Yeah. All right. So last question for you, Murray, before we let you go. I actually recently did personally some new estate planning because, as many people are familiar with, my first wife passed away. I've since remarried. That's a great reason to review your estate plan, obviously. But let's talk about reviewing it. When are some times that we're talking about building it, and let's say now we have an estate plan. What are the life changes that we should be thinking about in that would trigger a need for a review of that plan?
So if someone has a child, they need to look at getting an estate plan. Marriage or name changes. If you have grandkids, you want to add them as beneficiaries of certain things. A divorce would also be a good indicator that you'd probably need to come in and look at your estate plan. Yeah.
So you think about that. And this was, in my case, very prevalent. I had a guardianship clause in there, right, as far as that was part of the health care, right, naming a guardian for my kids. And that clearly was different because I have moved, remarried, I live in a different location, and that guardian that I had named while they're still friends, doesn't even live in the same county as me anymore.
Right.
So those were just some things that kind of came up that were a little bit hidden, quite frankly. I knew that I was going to do it, but I didn't uncover that until I went through the process of building a new estate plan.
And I don't think that's uncommon. I think a lot of people, when they're building their estate plan, don't necessarily understand all of the parameters inside of there. I've had many clients who come in and I'm like, okay, so what happens if you pass away? What happens if he passes away? And they can't always answer those questions.
Yeah.
So sometimes you need to just, if you don't understand how everything would flow, you need to get that checked out, and you need to make sure you funded it properly. Because again, it's just a heavy stack of papers if you haven't done the follow-up homework that was necessary afterwards.
So, Murray, before I let you go, I know I said that before the last question, but it's for real this time. Tell us a little bit about the appointment process. You've talked about it's a $1,500 cost, the full kit there. You get the trust, the will, power of attorney, healthcare agent, healthcare directive. What's the process like?
So you can call in to GenWealth and a team member will answer, or you can call to schedule with me and I will get you on the calendar, and then we'll have a talk kind of about what your needs are and what you're wanting, just to make sure that we're able to provide this service and that you don't need to go see an estate planning attorney. And so then after that, you'll come in, you'll do the initial appointment, we'll walk through everything, I'll send you home. You'll have a little bit of homework that I please ask you that you do it. It's very important for the next appointment. And I'll call in between the initial appointment and the signing appointment just to make sure that all your documents look the way that you want them to look. And then you'll come in and we'll have a notary and 2 witnesses. And then there will be some other decisions that need to be made during that time. And then we'll send you off with your binder, and everything will also go onto your wealth.com account.
Yeah. Murray, thanks very much for being with us. And you bring up a great point, too, because we will identify that first appointment is a little bit of a discovery process. I have gone through one with a client that we got down into the weeds and realized, you know what, we're not going to be able to do that. You are going to need an estate planning attorney because your plan is going to be a little bit more complicated than what we're going to be able to do. So it's really for straightforward, and honestly, our clients are mostly that. Most of our clients are pretty straightforward with their needs, but I think it is a great point that it's a little bit of a discovery process as well.
Yes.
Murray, thanks for being with us. Wasn't so bad, was it?
No, thanks for having me.
There you go. Great. It was the debut on the Get Ready for the Future show. First of many, I'm sure, for Murray Tudor, our estate planning associate. Thanks for being with us. We'll move on now to our next question. Tom via email. I'm 64 and retiring soon. I have the option to take a lump sum from my pension or monthly payments for life. How do I evaluate which one is better for us? Lump sum or lifetime income? This is a decision you only make once.
Yes.
So the right choice depends on more than just math. Now, just for clarity here, when you say take it as a lump sum, we want to first say this. We are going to assume, for purposes of this conversation, you are talking about rolling it over to an IRA. That's taking the lump sum, but it's not taking the lump sum, if you know what I mean.
Don't put it in the bank.
We don't want to cash it out. That's not what we want to do. So in the evaluation of this, we're going to assume it's a non-taxable rollover to an IRA versus do I take it as a lifetime benefit. So first, Teresa, let's kind of look at the math of it.
Yeah, I think it's really important to just take the emotion out of it and do the math. So if you compare the lump sum to what your income amount would be, and that income is more than 6% of that lump sum, it's a pretty good payout. That's not something we're necessarily going to be able to match most other places. So that is one thing to consider to make sure that it is logical for you to do. Now, if you're younger and this is a frozen pension, so they're giving you the option of taking the lump sum and moving it to a traditional IRA now because it's going to be a long time before you retire, you do need to count in potential growth. Because, you know, that lump sum may look good today, but if you pulled it out and put it in a traditional IRA, what could it grow to by the time you retire? So those are 2 things to really consider as part of the decision. This is not all of the decision, but part of the decision. Yeah,
moving on through that, the inflation component of this is huge too. Does your monthly benefit come with a cost of living adjustment? And in most cases, only a public pension is going to do that, like those afforded to are offered to teachers or firefighters, police officers, things like that. Private pensions are going away, period, but the ones that we've seen don't have a cost of living adjustment. So you have to realize that even in that math comparison, oftentimes your first check is your best check and your worst check. So your retirement income needs to increase over time. So that is a component of this too. So just doing the direct math on it is the first piece of that. But is that check going to get larger is the next thing to think about.
And I think with that, you've got to think about the flexibility and control of that. You know, when you make that decision to go with the pension option and to take that monthly income, you have given up any control over those assets. In most cases, there is minimal or no survivor's benefit or any sort of like lump sum that's going to the next generation. So for some people, that is a big piece of it. You're giving up the flexibility of how to use those. You're giving up the control over it. And, you know, it's not common, but there have been pension plans that have failed historically. And so that's something to consider. Is your company's pension well managed, or have there been problems in the past with it?
Yeah, and the other piece too, that this is where the monthly benefit may shine, although I'm going to kind of provide a little color around that even. The longevity component of that, you think about the monthly payment winning out there because you cannot outlive the monthly benefit. You could outlive the lump sum, but let me put the emphasis on could, because it would only be if it's not managed well, you raid it too often, you take too many and too large of withdrawals, or you make poor investment decisions. So that can be a lean towards the monthly benefit. But I think that's the other piece to that too is, and many of our clients that have this have come in and they've decided to take the lump sum. And that's not necessarily to say everybody should do that. But the reason here is that if you have this lump sum and you go through a retirement income planning process here at GenWealth, we can determine how much guaranteed income do you need, right?
Yes.
So when you incorporate the Social Security checks that you're going to have, and he does make reference to having an us, so there is a spouse here. So there's probably going to be 2 Social Security benefits. If you take that lump sum, you could use a portion of that to increase your guaranteed income if it is identified that you need to do that and really get the best of both worlds. You can buy something like an annuity with a portion of that lump sum that will add to your guaranteed income and then still have the flexibility of the remaining amount of that lump sum to invest for future dollars or discretionary income on top of that.
I did just that with a client last year. He had been really agonizing over which way to go, but a legacy was so important to him, and his Social Security benefit was substantial. His income needs were low. So we were able to take just a quarter of that lump sum, apply that to an annuity product that could provide the guaranteed income on a joint life basis for him and his wife so that they were covered. And then the rest of it was able to be invested in our ready to retire process to allow him to, mitigate the risks of market volatility, deal with the longevity needs, and get those inflation adjustments over time that he would not have gotten in the pension program.
I'll circle back to what I said at the very beginning. You only get to make this decision once, so don't go it alone. Hire a financial advisor to guide you through this decision and the rest of the decisions that you have in front of you with regard to retirement. Build a retirement income plan using both options so that you can compare. And again, choosing that financial advisor is key. If you'd like to walk through the GenWealth Ready to Retire process here, you can call us toll free at 866-653-PLAN. That's 866-653-7526, or shoot us an email, info@getreadyforthefuture.com. This is the question of the week, Tom. We're going to send you a free Get Ready for the Future show tumbler. There it is on the video screen for those on our live stream audience. We'll send that to you. We just need you to send us an email to claim it. Send it to show@getreadyforthefuture.com. Next question on the show is from Molly from Bauxite. We're in our early 60s and plan to sell a rental property in a few years. Should we be thinking about capital gains tax planning now or wait until we're ready to sell? Well, when it comes to real estate, the sale might be years away, but the tax planning starts now. It is never too early to do tax planning, especially when you've got some numbers to work with, right?
And a potential windfall of some sort. When you know it's on the horizon, planning ahead is always going to benefit you.
Yeah.
You need to think about your retirement income needs and desires so you can get your plan together, because I know it sounds weird to talk about, selling a property and then me shifting to a retirement plan, but let me explain why. Do you need to plan for that windfall from selling that property to help supplement your retirement plan, or can it be kept separate?
Yeah.
So you need to be thinking about the impact on your overall picture. I talk about trying to plan in a knothole. And I think the pension question and our other question with estate planning, often people see things as little pieces all on their own, but really it's all part of a bigger plan. So make sure that you understand where you're at and make sure you're including a CPA.
Yeah, that's for sure. We're not CPAs, but we do know this, and I have a little bit of personal experience in this as well, and we love real estate as an investment. I think the challenge, and you've already kind of hit on it here, when it comes to retirement income, you can't spend real estate, right? So are you going to need, Molly, some of the proceeds from the sale of this house to fund your retirement, or do you have other options for it? So determining the purpose there. But when it comes to the tax planning side, I do know this. The first question I would ask is, did you claim any depreciation over the time that you've owned that rental home? Most people do. Never run across anybody that didn't, because that's
Most
part of the
people
reason.
don't want to pay taxes.
Exactly. It's the taxes now versus the taxes later here, though. If you've been claiming that depreciation over the course of owning it, then you're going to have to recapture this and pay taxes on it, potentially increasing your tax liability. A CPA can help you with that.
I'm going to clarify your math, okay? Because there's a lot of words there that if you don't know them might confuse you. So pretend you paid $100,000 for the home and you have claimed depreciation. You've lowered the value of that home by taking tax credits over a 5-10 year period, and you've claimed, let's say, $80,000 worth of loss. Well, now technically, when you resell it, you only paid 20. You've claimed 80, you only really paid 20. So if you sell it for 200, you've got $180,000 worth of gain, as opposed to just what you originally paid, difference between that and what you sell it for. So I do want to be very clear about what that means for you. One thing you can do to mitigate that is if you can find records on things that you've done to upgrade that home, those can add back in. So if you haven't claimed those or written those off, you can add those back in to re-increase the original cost basis of the home. Now,
and here's another thing to throw out there as we kind of wrap up on this question. We've got one more to go before the show's over. There is something called a 1031 exchange too. So when it comes to, and again, I would not do this in a vacuum, but through the comprehensive financial planning that we're encouraging you to do, Molly, as you get ready to sell that house, you could create a very tax advantage situation for you by looking into a 1031 exchange. Now, people may know what that is because lots of people may have a rental home and they exchange it for another rental home. Well, that's not what we're talking about here. That can be part of that, but there are actually there is access to real estate in a different way using a 1031 exchange.
Yes, and you can purchase what's called a real estate investment trust product. These are kind of packages of real estate that you can invest in. And it's a complex product, so you really need to work with a financial advisor and make sure you've got a good quality one, because there's a lot of what I would call duds out there too. But it is another way to say, I'm going to take the proceeds from this sale, reinvest it into real estate a little bit differently, but avoid that taxation for a period of time.
Yeah, and there's a lot of things you would need to know about a real estate investment trust before entering into it. It's not right for everybody. It can be illiquid. You'd want to work with a financial advisor to see if that's right for you as well. Just throwing some options on the table to think about, because you're talking about capital gains tax planning now, even though you're not selling for a few years. Molly, thanks for the question. We've got time for just one more on the show today. This is from Bobby in Little Rock. I'm 61 and recently divorced. I'm keeping the house, but it's still got a mortgage, and I have about $500,000 in retirement accounts. How do I rebuild my plan now that I'm on my own? Late life divorce can certainly feel like starting over. Doesn't feel like it. It is starting over, right? Financially and emotionally. We're going to talk about how to get your footing again and move forward with confidence. You know, retirement is a lot different.
It is.
Single rather than married.
Yeah, I mean, you're talking about one Social Security check instead of two, even though the bills aren't going to be half, right? If you own a home, your mortgage didn't just split, your taxes, utilities, none of those things truly split. Some of your expenses may, but often it is going to stretch you a little bit more. But your decision making on how you take your Social Security needs to change. I would say in general, when your life happens, because that is what happens even with clients who aren't going through a late life divorce, life is going to happen. Just pause and reassess. Get a financial advisor to go over everything and just come up with something that works for you. It may be that your whole vision for retirement has changed now, and that's okay. But we want to make sure your plan works for where you are now, not where you were 5 years ago.
Yeah, and we don't know where Bobby was in terms of, was he the spouse that was more in tune to that before when he was married, or was his wife? There's usually one, usually not both, and I think that's the best way, honestly, that it works. One, because you'll have a lot of arguments if both of them want to make the decisions, but it is time to reevaluate whether he was in tune with it or not. And I do think $500,000 is not an awful place to be.
No.
And let me reiterate that for anybody listening today, especially Bobby's from Little Rock. If you're living in Arkansas and you have a $500,000 nest egg at 61 years old, you can do a lot with that. You can have a retirement. It may not be what you originally planned for, Bobby, but it can certainly be better than you maybe expect. But you've got to be willing to make a plan. And depending on how recently Bobby was divorced, it depends on how much he has worked the new budget, worked the new income versus expenses. Work on that, and that can lead him into some retirement income planning.
And I think there are some other pieces that might get missed or that we've seen get missed. First thing is, we talked about it earlier today, when you have a life change, you need to evaluate your estate plan, make sure everything's still in alignment, communicate with any of your healthcare providers. If you don't want your ex-spouse to be able to get your records and things like that, and you've given permissions in the past, you need to make sure to follow up and adjust those. You also need to review all of your beneficiaries on all of your accounts. So bank accounts with your payable on death designations, your personal retirement accounts. In some cases, it makes sense to keep your ex-spouse on there, but if it doesn't, make sure you do an evaluation and it's in alignment with what you want now. Yeah,
so let's circle back here, as we've got a little less than 3 minutes before we hit our final thoughts. But we talked about Bobby needing to analyze the budget, look at income and expenses, determine after he does retire, what does that look like? What are income and expenses then? It's so important, and it's something that we walk through in the GenWealth Ready to Retire process right out of the gate with our clients, because when you build your plan, and when Bobby wants to know, how do I rebuild my plan now that I'm on my own, I have $500,000, you've got to make that nest egg. You've got to make those retirement savings become income to you. And retirement's an income problem, and the first thing you've got to cover with income is your required income, which means your expenses need to be met. Ideally, and in the Ready to Retire process, we work towards a guaranteed income stream for the expenses that are not going to go away in retirement. So we need to make sure Bobby's got enough Social Security ready for him at retirement. And if it's not enough, we may need to use a piece of the assets, as we referred to earlier, to build more guaranteed income through a product like an annuity. And then the remainder of the assets can be used to build in the discretionary income and provide raises in retirement, because we talked about that earlier too with the pension, right? It's not going to give you a cost of living adjustment in most cases, so you've got to be able to raise that income, and that kind of leads me into the investment strategy that needs to be in place now for Bobby, even if he isn't retiring at 61.
Yes, even if you're not ready to retire, the market can be finicky, right? If you were getting ready to retire, you were going to retire into 2008 and you're not ready for what happened in 2008, that can derail you. So even at 61, you may have the option to do what's called an in-service distribution, where you can shift the assets in your employer plan to an IRA. I can't tell you whether it makes sense for you without talking to you personally, but it is something to consider, because what you can do at that time is you can say, okay, I've got my income plan because I've met with somebody, we've got that lined out. You can go ahead and get it prepped so that when you're ready to retire, you have everything ready, and if a market downturn happens, you're already prepared for it.
We are talking today a lot about life changes, right?
Yeah.
We're talking about divorce. We're talking about selling a rental home. We're talking about paying off a house and dealing with some estate planning. You know, there are so many instances where the life change, and I would say in my experience as a financial advisor, that's what triggers people to come in.
Yes.
We can sit here and tell you need a retirement income plan, and some people do act on that, but usually retirement, death, divorce, moving, inheritance, changes in your financial situation is when your need is realized for a financial advisor. So I want to encourage you to reach out and get started. If something like that has happened to you, don't wait any longer. Don't just wonder about it. Don't make the decision in a vacuum. Get started today on building your plan, because the plan will give you the answers to your questions.
Yes.
And I think that's the people want to know in this world today. And I know we heard the final thoughts, but everything's different today. So I'm just going to make everything different.
We're just going to do whatever we want.
But in today's world, we're on TikTok, we're on Instagram,
Mm-hmm.
we're getting bite-sized, not even bite-sized pieces. We're getting flyby information
Yes.
that's 8, 9, 10 seconds long, and we want to be told what to do like this. It takes a little more time than that.
And I think anytime you're dealing with a life change, there is a piece of waiting that needs to happen. But many of these life changes, there's a time limit. You know, if you're going through a divorce, there's a time limit for accomplishing certain tasks. If you've lost a family member, there's a time limit on taking care of their estate. So it's really important to prioritize and then pause.
Yeah.
Get your plan together. Get with an advisor, get your estate plan together, do what you have to do, and then you have the breathing room to pause.
Yeah. And I think, too, a lot of people are looking for a right answer versus a wrong answer. And sometimes it's a little more nuanced than that. It's the answer versus a better answer,
Yes,
if that makes
those
sense.
are my least favorite on tests, but that is life.
Yes.
There's sometimes a better and a good.
Yes.
And it's okay to do either.
That's right.
But I'm with you on that too.
But you want to optimize
Yes.
your retirement. You only, like we talked about with the pension, you only get to do it once. So if you want to step into the GenWealth Ready to Retire process, we've got an advisor here at GenWealth ready to sit down with you. We've got locations all over the state of Arkansas, as well as an office in Northwest Louisiana. So someone is near you geographically. We'll create a match for you. Just reach out to us and call this number, 866-653-PLAN. It's 866-653-7526. Or send us an email to info@getreadyforthefuture.com. And that's all the time we have for this week's Get Ready for the Future show. Again, want to encourage you to get those questions in to us by calling 501-381-5228. You can leave a voicemail or you can text in a question, and we might use yours next week. See you then.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.